Good day, friends. In this subject of fundamental of investment, we are talking of trading in the stock market. That is, what is the procedure involved in the trading in the market. That is, if you want to buy and sell the equity shares, stocks, what is the procedure involved in buying and selling and how you do it. So, in my previous lecture on the trading in the market, I have talked about two steps I have explained, apart from the other things, that is, what are the advantages of online trading, right, how you do it and all these things, right. So, there are two steps which I talked in my previous lecture, that is selection of a broker, in which the credibility of the broker, the standing of the broker, the registration with the Securities and Exchange Board of India, and the broker must be the member of the or means registered sub broker of the any of the exchanges with the any of the exchanges, right. So, basically the first step is that finding a broker, and the second step is that you must have a demat account, depository account. So, these two steps we discussed in length in my previous lecture on online trading. The third step is, once you have in place your broker, you have a depository account, and I was talking of the opening a depository account, which I said is an electronic form of holding the equity shares, right. So, your bank information, your PAN number, your residential proof, right, all this is already there with the depository and with the broker. So, the third step now, after having the prerequisite of trading, now if I want to buy it, if I want to sell it, what is the process of buying a share, right. So, the third step is to place the order with the broker. As I said in my previous lecture, that any of the exchange, the two leading exchanges which I was talking in my previous lecture, BSE and NSE, they do not deal directly with the customers, ordinary customers. Ordinary or large means they do not deal. They deal only through their registered brokers, right. And any individual or even the corporates or any firm also, if you want to buy or sell the shares, you will have to open an account with some broker, right. So, since the broker deals directly with the stock exchange, or broker is entitled, broker is the right person or right firm, right, to deal with the stock exchange. Right. So, when you want to buy some shares, you place an order to the broker. These days, with the help of computers, with the help of the mobiles, with the help of the telephonic things, within seconds you can place your order. So, you place the order with the broker, and the order can be communicated to the broker either personally or through mobile phone or through online platforms, right. So, the broker will provide you some code, and the moment you will have your code, in your mobile or on your screen, right, you will open an account of your trading account. Immediately you can trade on that behalf. You can place the order up to the limit which the broker has given to you, and your bank account is already attached with that, right. So, there is system in place through which you can place the order. The instruction should speedily specify the securities to be bought. What you have to do? You have to specify that which security, which company's share you want to buy or sell, and the price at which you want to buy and sell, right. It may be, I'll be talking about different types of order, but there must be a price range or price at which you want to trade, if you want to buy or sell. So, only the securities of the listed companies can be traded on the stock exchange. Friends, there are more than 5,000 companies which are listed in the stock exchange, that is BSE and the NSE. There are certain companies which have issued the shares, but if they are not listed in the stock market, they are not listed in the stock exchanges, the two stock exchanges which I talked about, they cannot be purchased and sold through these stock exchanges, right, through the brokers. So, it will be just private dealing, private placement, private buying and selling. So, securities which are listed in the stock market, in the BSE or the NSE, only those companies can be traded. So, securities of the listed companies can be traded on the stock exchange. And let me tell you that for listing procedure, There are certain requirements as per the SEBI guidelines, Securities and Exchange Board of India, which time and again I have said that it is a regulatory body. So this Securities Exchange Board of India has set certain guidelines for the exchanges, and exchanges also have their own norms for getting the shares listed in a particular exchange, and they obviously charge the two exchanges charge some nominal fee, annual fees, and fee for the getting the shares listed in the stock exchange. You may ask me, and the question will come in your mind: what is the purpose of getting the shares, getting the company listed in the stock exchange? Suppose the company is not being listed in the stock exchange, so there will be huge problem of liquidity. That your company or any company has issued the shares. Why people buy the shares? One of the very important feature of the equity share is that they have a liquidity. That any time you want to buy or sell the shares, you can do it through exchanges. So if your if the shares of a company is not listed in the stock exchange, how you will trade it? Then even the broker finding a buyer or a seller, vice versa, right, will be very difficult. Will be very much difficult if the share is not being listed in the stock exchange. So here we call it ask or spread. There is a price quotation, bid versus ask. I want to buy a share at 150 rupees, right, and seller want to sell it at 151 rupees. So this difference of 150 and 151 is called spread. Means the buyer wants to buy at 150. I am presuming there is only one buyer and one seller. Practically there are thousands and thousands of buyers and sellers, but just to make you understand that if the buyer want to spend 150 rupees on a share, on a particular share, at one share of a company at 150 rupees, seller is interested in selling, seller want to sell it at 151 rupees. So this difference of 1 rupee is called spread. So the ask is greater than bid, means the seller price, the price at which the seller want to sell, is ready to sell rather, I would say, is called ask price. So ask is greater than the bid. The trade will not happen. Trade will happen when the bid and the ask will equalize, they match, then only the trade will take place. So larger is the spread, lesser is the liquidity of the share. You will find that good companies having very large volume, the stock exchanges have very minimal spread, right? So the spread indicates the liquidity of a particular share in the market. So this difference of the buying means the ask price and the bid price is called spread, and spread represents the liquidity in the market. So bid is the price at which the buyer is willing to pay, the ask is the price at which the seller is willing to sell, and this difference is called the bid and the ask price is called the spread. So spread is an indicator of liquidity of the stock. As I just said, that if the spread is less, it shows there is a higher degree of liquidity of that particular stock, right? So you will find that those companies which are trading in large volume in the stock exchange, right, they have a lower spread, right? So there are different ways in which you can quote the price. When you buy or you want to sell it, there are different ways of quoting the price, right? When I'm talking a point, that is, you place the order. How you place the order? There are different ways in which you can quote your price. So various terms used in the NSE trading screen is open. Before talking of that, let me talk of this point, that there are different terms that is being used, that is being these are important for price quotation purpose. Open. Open means the price at which when the market opens in the morning, the first trade that takes place at a particular price, that is called opening price. So it is the opening price of the security for the day. I'll be telling you the relevance of this also. The other thing is close. The price at which the last trade takes place is called a close. So it refers to the closing price of the security happened in the previous day. Means if I'm talking of today, yesterday what was the price that at which the particular security was closed? That is called closing price, right? So if I'm talking of today, if I say at 3:31 p.m. because the trading takes place from 9 to 3:30 p.m., right? So at 3:31 p.m. that will become the last price, that is at 3:30, or any price which is on that particular day, the price at which the last deal takes place, that is called the close price. High. It refers to the highest price at which the stock dealt during a particular day, right? On a particular day, what was the highest price of that share? The other thing is low, just opposite of it is called low. The lowest price at which the stock dealt during the day. Right. Friends, why I am talking of these things, price quotations, high, low, open, close, right? And then last traded price, like close price, it refers to the last price paid for the stock on a given trading day. It is called known as settlement price. And the volume, it indicates the number of contracts settled on a particular day of a particular stock. Turnover. I will be explaining the relevance of all these terms. Turnover, it is the notional value of the contract. Means on a particular day, what is the amount of transactions? There are hundreds of transactions that may take place. Like if I name a few companies like Reliance Industries Limited, HDFC Bank, HDFC, Infosys, TCS, Tata Motors, Tata Steel. These are the companies where the turnover is very large. They are called large capitalized firm, right? So the value, the total value of the transactions that takes place on a particular day is called turnover of the particular equity shares in a particular day. Upper circuit, lower circuit. Upper circuit means in order to check the fluctuation in the stock market, the exchanges, that is the BSE and the NSE, guided by the SEBI, fix up the upper limit and the lower circuit. Upper circuit means that what is the maximum price that can go on a particular day. Normally it is 5% to 20%. That is depending on the volatility in the market. In its wisdom, the stock exchanges take a decision. The idea is that there should not be very high degree of fluctuations. Supposing, God forbid, some war happens, and in a war time the stock market crashes sometime, right? So if a country is in war, certainly the economy will not do well, and when the economy will not do well, certainly the companies will not do well. So in that case, there will be a lot of fluctuations. Suddenly news comes that there is a war in the country. So because of the war, the market will fall, or there is some big natural calamity, it will lead to the fall in the market. So we want that the stock exchanges want that there should not be a very high degree of the fluctuation of a particular share, or sometime even some of the manipulation, if at all somebody wants to do it, and it affects the share price. So what they do is that they check this fluctuation and they fix the upper circuit and the lower circuit. Upper circuit means the maximum price at of the share that can go on a particular day. Supposing shares normally goes at 250 rupees, 230, 240. This is the range. So maximally it can go up to the maximum up to the 5% to 20%. That is the maximum level at which the price can be traded on a particular day. Similarly, lower circuit means the minimum price, the lowest price which a particular share can go on a particular day, right? So it is the least price to which an index is allowed to fall in a given session. It may be on index basis, or it may be on a particular shares, upper circuit and the lower circuit of a share. Friends, why these are important? These terms, open, close, the different terms we use, last trading price, volumes, high, low, right? There are very large number of transactions. There are large number of individuals who do trading in the stock market, who buys and sells shares on a day-to-day basis, on a same day, right? They square up the transaction on the same day, right? So, and those people, there are two things in the stock market. One is called fundamental analysis and other is called technical analysis. Technical analysis, we will be having a separate lecture on this, but just in a line or so I will say, technical chartist or technical analyst study the volume of a share. They study the high price of the share, the low price of the share, what is the closing price, what is the opening price, what is the difference between opening price, whether over a period of time, a week or 2 days, 3 days, 5 days, whatever their time limit of their time period of the study is. They see every day is the shares is closing at every day on a higher and higher basis, right, or lower and lower basis, vice versa. So on the basis of that, they predict the future, the technical analyst I am talking of, right. So all these things are very much relevant, that what is the turnover, but larger is the turnover, like say for example, foreign financial institutions or even institutions in India operating in mutual fund houses, right, financial institutions in India, they don't trade in the share where the volume is very low, because supposing they want to sell in the large volume, they will not able to sell. They want to buy in the large volume, they want to buy 10 lakh share of a particular company, they will not able to buy because the turnover of the share is low. So normally the large financial institutions or the large brokerage house, so large funds houses deal only in those shares which have a reasonably good turnover, right? And as I was saying, open, low, turnover, high price, low price, these are very important terms to study the movement of the shares, and on the basis of the movement of the shares, the people judge the future trend of the share of the stocks, or for the matter even the whole index also, right? If you want to see where the index will be after 7 days, after 10 days. So if you are a technical analyst, you, by reading these things, by studying these things, you can make out something about the movement of the stock index. So stock window. Now after talking of these different price quotations, right, let me talk about what is the stock window. Stock window, when you open an account, when you open your computer, and if you have a direct access with the NSE or the NSE through your broker has given you the number, right? So a stock window can be opened on a particular window that will show about the detail of the share. So stock window shows the list of buyers and sellers of the security. The seller asking the price at minimum price is considered as the best seller. If you want to sell from stock market point of view, the seller who is ready to sell at the least price is considered as is being known as best seller. And other ways around is the case for the buyer, and is given the top rank in the selling list, means the first deal that will take place, of first transaction that will take place, will be of the best seller, the seller who has quoted minimum price amongst the sellers who want to sell their share, right? So buyer bidding the stock at the maximum price is considered as the best buyer. In case of seller, who is the person who want to sell the share at a minimum price is being considered as a best seller, and in the buyer case, the buyer who want to buy at the highest price is being considered best buyer. Because in the stock market, in the stock exchange, BSE or NSE, right, the first transaction that takes place, when I am saying first, means at a given point of time and at a given time, when the best buyer and the best seller matches. So transaction get completed when the best buy order matches with the best seller order. The minimum price for the seller and the highest price for the buyer. This is the stock window which I wanted to show of any company, means high price, low price, 52-week high, 52-week low price, and so on and so forth. The price at which the different buyers and sellers are ready to buy and sell, all these are being shown in a stock window, right? Now I'll be talking of types of order. When you're placing the order, there are 3-4 points which I would like to refer: market order, limit order, stop loss order, aftermarket order, right? So basically my focus will be on the market order, limit order, right? So this will be my focus. What is market order? If you want to buy or sell shares, you give instruction to the broker that buy at a market price. As I was just saying, the deal takes place at a best buyer price and the best seller price. What is best buyer price? The maximum price at which the buyer is ready to buy, and the best seller price is the minimum price at which the seller is ready to sell. When this best buyer and the best seller meets at that price, the transaction takes place. So market order means you give instruction to your stockbroker that buy at market price. Whichever the best price at that point of time where you are placing the order, the deal will take place, right? So there is no limit which you are giving. Supposing I am talking of X company, which is trading around 1,000 rupees on a particular day. It may be 999, it may be 1005, 5010, it may be 995, like that. This trading in that. You give an order that I want to buy this, and you know it that this is the range in which the share is trading, right? So you say buy it as per market rate. So it means whatever the price, the moment you will, put your transaction for buying, whosoever the best seller will be, means the minimum price at which the seller is ready to sell at that point of time, right? So your transaction will be done. So buying and selling price of the stock is not specified. You have not given a specific price that I want to buy at 995 rupees. No, you are saying buy as per market rate, right? So is specified because the order is executed at the current market price. The order is submitted and executed instantly because you have not set any limit. So it cannot be used to set stop loss. The main advantage of the market order is that trader is guaranteed to complete the trade. There is risk of slippage in the market. There is a slippage in the market means, what is slippage? Slippage is the difference between the expected price of the trade. It occurs due to seconds or minutes time lag between placing the order and its execution. Supposing, because these days there is a lot of transparency, I see at a particular point of time that this particular share is trading at 995 rupees 50 paisa, and I place the order through computer or through my mobile. There may be a difference of 10 seconds, 15 seconds, 20 seconds. In this difference, the price may fluctuate by 20 paisa, 30 paisa, 50 paisa or a rupee or any fluctuation. So this difference in the point at which you place the order and the execution of the order that takes place is called slippage, right? I have already explained. So limit order. The other one is market order, the other is called limit order. Limit order means where you set a particular price that I want to sell this share at this very price. That is called limit order. So buying and selling of the price of the stock has to be specified. There is a cap on the buy price and the sell price. That is, suppose a seller places a sell order. Will say, I want to sell the share at 1005 rupees. It means there is a limit that if the price is less than 1005 rupee, the transaction will not take place because you have set a particular price. Reverse is the case for the buyer. That is, buyer says, I want to buy at 995 rupees. So if the price comes to be 995 rupees or a particular share on a particular day, then only the transaction will take place. Means at the time of placing the order, the buyer or the seller, as the case may be, is specified a price at which the buyer and the seller want to transact. That is called limit order, right? So this I have already explained. Limit order sells it at above the market price. The limit order is buy at below the market price. Means as the case may be, the price I will say whatever the price you will fix. Stop loss, this term is quite often being used, especially for the traders. This term is very useful especially for the traders. When you buy, you want to limit your loss, right? I have purchased a share at 995 rupees. I think that maximally 5 rupee loss I can bear. If I bought 1000 share at 995 rupees, I am ready to lose maximally 5000 rupees, 5 rupees. So what I will do is that I will put a stop loss that if shares of that company of which I have bought at 995 rupees, if it comes to 990 rupees, immediately it should be sold. Especially those people who follow technicals, those who want to limit the loss, and those who are trade on a day-to-day basis, they should always use this stop loss system because stock market sometimes fluctuate too much. So in order to limit your loss, in order to minimize your loss, you have purchased a particular share with the intention that it will go up. Supposing something happens and the price falls, in that case your loss will be limited. That is, the maximum loss that will take place is 5000 rupees. 5 rupee fall and 1000 rupees, 1000 number of shares. So maximum loss is 5000 rupees. So especially the traders, they use this term of stop loss. Stop loss means the moment a price falls below that or reaches that level, the transaction will be squared up. Squared up means you have purchased it, so it will be sold. So it ensures discipline in the stock market while investing. A buy stop order is a place above the market price and sell stop order is placed below the market price. Right. So I have already explained. The next point and the last point is executing the order. As per the instructor of the investor, the brokerage buy or sell the securities. The broker then issue a contract note. This is very important, that whenever any transaction takes place in the stock market, as an individual, if you make the transaction through the broker, broker should issue you a contract note. Contract note is a contract between individual and the broker, means the buyer and the broker. That broker has sold or bought the share at this very particular price, right? And these days, since T+2 settlement system is being followed in India, that is the day of the transaction plus 2 working day. Suppose you buy or sell, as the case may be, on Monday, right? So 2 days by Wednesday, 2 trading days. Day of the transaction is called Monday, that is called T day, and T+2 by Wednesday, the transaction should be completed. So if you have purchased it, it should come in your account, and if you have sold it, the price should be credited in your account. So we call it T+2. So settlement must be done in T+2 system. So there is a last stage in the trading process. The mode of settlement depends on the nature of the contract. So equity spot market, I have already explained T+2 settlement, right? So delivery of the share is there, that it will be given in your depository account, and if you have purchased the shares, right, so the delivery of the shares should come in your account, right? So the rolling settlement is same T+2. Earlier in the past in India, T+5 settlement system was there, but these days the 2+2 settlement. And nowadays, I mean, even the stock exchanges are thinking of making T+1 settlement system, which will be the very highly efficient system. For that, the SEBI and the NSE and the BSE, it's making the provisions, and certainly certain changes are to be done, right? They need certain changes, and then the T+1 settlement, but it will be highly efficient system if we are able to implement T+1 system, right? So friends, in this way, transaction is being done in the stock market. You have you have a dealing with the broker, that you must open your account with a broker, then you must have a depository account, and with the depository account you place the order, and then the order place the order with the broker, and broker, since they deal directly with the BSE and the NSE, the transaction will take place, and as the case may be, the account will be debited and the credited from your depository account, right? So this is the process of trading in the stock market. Thank you very much.